Roth is better in the low tax bracket years or when your income tax situation is low because there's a small liability to pay and now that money can grow tax free into the future. You don't have to worry. Mistake number three when it comes to retirement planning is not making the right type of contribution. When we talk about saving money for retirement, it's not just Roth versus traditional. There are so many other places that we can save and invest for our future that can make sense. We've got brokerage accounts, we've got health savings accounts. There's a lot out there, plus IRAs, 401ks. There's a whole gambit of employer sponsored retirement plans. But let's just narrowly focus in for a moment on the idea of Roth versus traditional. As you're aware, Roth money, that's money that either you put in initially after you paid the tax on it and it grew tax free from that point forward, or that you've converted from pre tax or maybe after tax to Roth. And so now it's growing tax free into the future. Traditional money, that's money that you put in. You got a little tax benefit when you put the money in because the IRS did not recognize it as income. But now, down the road in the future in retirement, every dollar that you pull out generates ordinary income and is taxable in the year you take the money out or when the government forces it out with required minimum distributions. For some people, it's making Roth contributions when they're making the most amount of money they've ever made in their career, and that would be unwise. For others, it's making pre tax contributions for too long. And now, as they're looking down the road into retirement, they're recognizing that those required minimum distributions that they just learned about are now going to force them into a higher tax bracket than they ever imagined they would be in while they were working because they've saved and their investments have done really well. Okay, Roth, historically or traditionally speaking, is better in the low tax bracket years or when your income tax situation is low because there's a small liability to pay and now that money can grow tax free into the future. You don't have to worry. Who cares what Congress is going to do with changing tax legislation because the money that you have in the Roth, hey, it's going to grow. And even if Congress years down the road raises tax rates, you don't have to worry because the money in the Roth, when you distribute it out in retirement, is completely tax free. That's pretty awesome. So if you expect taxes to be higher in the future, Roth makes a lot of sense. If you expect your taxes to be lower in the future, then of course we want those traditional or pre-tax contributions. So let me share with you a little story here. And all these names are fictionalized, but they represent real life situations here. To protect identity, we'll say Layla is 59 years old. She contributed big time to her traditional 401k throughout her life. She was disciplined. She always took advantage of her employer match. She put the money into a 401k and she was just diligent. She wasn't trying to play games and time the market or do any of that. Now faces some really high RMDs, required minimum distributions, and big time tax bills. What's the solution to her problem? Well, if we could go back in time, we would have recommended to her to diversify her taxes. She was great on the investment diversification, but not great on the tax diversification. And Roth makes a lot of sense. Now, has that boat sailed? No. Even though she didn't make contributions into her Roth 401k, but if you didn't know, we'll peel back the curtain. Her employer didn't offer Roth 401ks as an option until much later on in her career. But even though, set that aside, we can still do Roth conversions to diversify her tax exposure. So she's preparing for retirement. She's seeing these RMDs coming down. She's making about $150,000 a year. Now it's her peak earning years. It's pretty much the most she's ever made over the course of her career. She's got $850,000 in a traditional 401k. She just started a Roth IRA recently, and she's got 50 grand there, and then 100,000 in a brokerage account. Her goal to retire at the age of 65 in 6 years, and she wants predictable, tax-efficient income in retirement. She always contributed her 401k. She never thought Roth was right for her. And now she's in kind of a tough situation because that $50,000 in the Roth is not going to last her very long. When she turns the age of 73, RMDs will force her to pay more in taxes and have an alternative impact. She'll pay more in Medicare premiums because of IRMA. IRMA is the income related monthly adjustment amount, which essentially is a tax in and of itself, but it's additional premium that she has to pay for Medicare coverage in those years in retirement, because as her income goes up, the amount she pays for Medicare also rises. Something for you to be aware of that you may not have considered as you've been saving. Why does this all matter? Tax diversification is critical to managing taxes now and especially in the future. Now, we don't have a crystal ball. We don't know what tax law will look like next year, let alone 5 or 10 years from now. But the more we can put ourselves in a stronger position, the more we can plan ahead, then we can be prepared when the time comes. So that if taxes are significantly lower in retirement, wonderful. We've got the pre-tax stuff, we'll take it out, we'll pay the tax, but we're not kicking ourselves. However, if taxes go up significantly in the future, well, great. We have some Roth money that we can pull from. And let's be clear, this is not all or nothing. I was asked a question the other day. Is the goal when you retire to get everything from the pre-tax to the Roth IRA? No. For the vast majority of families out there, that's not the goal. Rather, it's to reduce the tax exposure you have in your portfolio, to reduce that tax liability to an acceptable level so that you can live the life you want to live and have the confidence that you're taking advantage of the tax code instead of just letting the tax code take advantage of you like it's been doing your whole life as you've been working and saving. Now you're at the point where you have assets and you can control your income. See, when you do a Roth conversion, you can say, I want to convert $35,000 to Roth. Or you can convert 25 or 15 or 135. I mean, the choice is yours, but you can nail it right on the head for how much you want to convert and how much in income you're going to pay. Tax planning and retirement planning go hand in hand. Please don't think one is separate and distinct from another. And listen, taxes, they can be confusing and complicated. You don't have to know everything. You just got to know a few key strategies and principles, and you can win when it comes to financial planning. I want you to make the right decisions for you long term. So what happened to Layla in the end? Well, once RMDs kicked on, once they started, she was forced to withdraw more money than she needed, pushed her into a higher tax bracket, higher Medicare premiums. She paid taxes on up to 85% of her Social Security benefit because Social Security laws did not change. And the Roth account that she did have, it was not large enough to make any real difference for her or her family. What should she have done? She should have made a little bit more Roth contributions in those years while she was working. She should have considered Roth conversions once she did retire at 65, or maybe she went part-time in those last few years. Whatever the case may be, once her income dropped, boy, that makes a lot of sense. She should have, in this situation, delayed filing for her Social Security benefits until after her full retirement age of 67. She shouldn't have taken it at 65. When she retired, she shouldn't have filed for Social Security early. That would have helped to kind of push that income out a little bit further, also increases the monthly benefit, but gives us a few more years in between when she retires and when she receives Social Security to maximize those Roth conversions for her, ultimately saving her quite a bit of taxes in the end. My name is Rizik. I'm a financial advisor, CPA, certified financial planner. If you enjoyed this conversation, you're going to love my book, Finance on the Fly: Simple Strategies to Build Lasting Wealth.